Good morning, venture capital. This is Metagame, and today's episode is about the stunning upheaval in energy markets where traditional fossil fuels are in freefall while alternative power sources are experiencing unprecedented booms. Capital didn't leave energy last quarter, it just decided molecules are out and electrons are in. Here's what I mean. Other energy, deal counts surged 85.7% quarter over quarter, 26 deals in Q4 versus 14 in Q3. Meanwhile, oil and gas contracted 38.9%, 11 deals versus 18. That's not a rounding error. That's not seasonal noise. That's a structural rotation happening in real time. And if you're still underwriting reservoir risk while the smart money is chasing grid infrastructure, you're playing the wrong game. Let me paint the picture. The SEC's other energy category is their polite way of saying everything that isn't pumping crude out of the ground. Grid-scale battery storage, virtual power plants, distributed solar platforms, geothermal, nuclear fuel cycle innovation, all of it lumped into one catch-all bucket. And that bucket just had its best quarter in years, while traditional upstream hydrocarbons bled out. Now, why does this matter to you? Because this rotation isn't happening in a vacuum. It's being driven by three forces that are about to reshape energy investing for the next decade. Force number one, grid-scale storage is becoming a distinct asset class. Not a venture bet, not a science project, an actual infrastructure asset with contracted cash flows. In March, GridStore closed a $120 million financing package for the Gunner Reliability Project in Texas. That's 150 megawatts, 300 megawatt hours of battery storage. The capital stack? Construction debt from Nord LB, tax equity bridge, letter of credit facility from Siemens Financial Services. This is the kind of other energy deal that shows up in SEC filings, not a Series A with a pitch deck about changing the world. A project finance-backed infrastructure asset with offtake contracts and grid interconnection rights already in hand. Force number two, federal credit is de-risking deals that traditional venture and PE wouldn't touch. The Department of Energy's Loan Programs Office just closed a $289.7 million loan guarantee for SunWealth's Project Polo. What's Project Polo? Solar PV plus battery storage structured as a virtual power plant. For the uninitiated, a VPP aggregates distributed energy resources, rooftop solar, behind-the-meter batteries, and presents them to the grid operator as if they're a single dispatchable power plant. The grid sees one asset. The investors see a network of contracted cash flows. The federal guarantee de-risks private co-investment, which is exactly why other energy deal counts can surge even while traditional energy VC activity flatlines. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. Force number three, firm clean power is becoming the AI infrastructure play, and this is where it gets interesting. $202 billion flowed into AI last year. Models, infrastructure, applications, all of it requires compute, and compute requires power, not intermittent power, not, we'll figure it out when the sun isn't shining power. Firm, dispatchable, always-on electricity. Data centers running large language models are now the fastest-growing source of electricity demand in developed markets, and they need power that shows up 24/7, 365. This AI-driven demand shock is reshaping where energy capital flows. Behind-the-meter generation for data centers is becoming an investable category. Natural gas gensets, fuel cells, nuclear small modular reactors, hybrid solar plus storage plus gas peaker configurations. All of it falls into other energy in SEC taxonomy. All of it is attracting venture and growth equity because hyperscalers are signing long-term power purchase agreements to secure capacity for AI compute. When Microsoft explores agreements with nuclear developers, that's not a press release. That's a bankable revenue stream for energy infrastructure platforms. When Google signs a 24/7 carbon-free energy PPA, that creates a multi-decade cash flow that makes other energy deals financeable at scale. Meanwhile, oil and gas is contracting. 11 deals in Q4, 18 in Q3. That's nearly a 40% drop during a period when WTI crude has been range-bound and upstream operators are returning capital to shareholders rather than drilling. Private equity activity in oil and gas has shifted to asset monetizations, bolt-on acquisitions within existing portfolio companies, and structured credit rather than new platform builds. The SEC data is capturing a moment where LPs are hesitant to commit fresh capital to traditional upstream strategies, while sponsors work through existing portfolios rather than launching new funds. The Brookfield Global Transition Fund E2EA raised $13.7 billion in Q3. That's not venture scale, that's infrastructure scale capital explicitly targeting grid infrastructure, renewables, and decarbonization platforms. The LP base writing checks into energy transition, and the LP base writing checks into upstream hydrocarbons are diverging. They're becoming different investor populations with different return expectations, different hold periods, and different risk tolerances. So what does this mean for you? First, recognize that other energy is a catch-all, which means deal quality is wildly heterogeneous. A grid-scale battery project with a 20-year offtake contract looks nothing like a pre-revenue fuel cell startup. VCs and PE firms that treat other energy as a single sector are going to misallocate capital. The winning move is subsector specialization. Are you a storage infrastructure investor, a geothermal developer, a nuclear fuel cycle VC, a distributed energy software platform growth equity shop? Pick your lane. Generalists will get burned.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
Second, if you're not fluent in federal credit structures, you're leaving alpha on the table. Tax equity, investment tax credits, production tax credits, loan guarantees. The capital stack for other energy often includes a federal credit layer that dramatically improves risk-adjusted returns, but only if you know how to structure around it. DOE just announced a $171.5 million funding opportunity for next-generation geothermal field tests. That's not charity. That's de-risking capital for private co-investment. Firms that can navigate these structures have a structural edge. Third, the AI power arms race is real, and it's creating a new category of must-own assets. Nuclear SMRs, geothermal, advanced storage, all positioning as AI-ready baseload power. The VC or PE firm that builds a portfolio of platforms capable of signing 20-year PPAs with hyperscalers isn't just backing energy companies. They're building the next-generation utility. They're capturing margin that traditional oil and gas upstream operators can't access because they're not solving the problem hyperscalers actually have. Project Omega exited stealth in February with a $12 million seed round to convert spent nuclear fuel into power sources for defense and military applications. That's not a reactor startup. That's a domestic fuel cycle play, framing itself around energy security. DOE is funding geothermal because it offers baseload, dispatchable generation without the intermittency challenges of solar and wind, exactly what grid operators and data center developers need. Bloomberg NEAF reports that energy transition private funds have raised nearly $230 billion over the past decade. Real assets, infrastructure, and natural resources now dominate private market energy investing. This isn't venture-scale seed rounds with 10-year horizons. It's infrastructure-scale capital with multi-decade hold periods. If your fund structure doesn't match that timeline, you're competing in the wrong arena. Here's the question I'd be asking if I were you. Are your energy allocations aligned with where private capital is actually flowing? Or are you over-indexed to legacy upstream strategies that worked in 2015 but face structural headwinds in 2026? Because the data is clear. 85.7% surge in other energy, 38.9% contraction in oil and gas. Capital didn't leave energy. It rotated from molecules to electrons, from reservoir risk to EPC execution risk, from commodity exposure to contracted cash flows. The firms that recognize this rotation and position accordingly will capture the next decade of energy returns. The firms that keep chasing the upstream dream, well, they'll have plenty of time to think about what they missed while they're working through existing portfolios and explaining to LPs why their vintage underperformed. Molecules or electrons? Pick your side. The market already has. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.